Well, it's a good question. I think in the short term it probably doesn't mean that much, but if the interest rate differential rose significantly, let's say the US gets to 2.5 or 3% eventually, as some of the dot points seem to indicate, then that would be a significant gap. As I mentioned earlier, there would be downward pressure on the Australian dollar, presumably. But again, there are other factors, such as commodity prices and the like. And in fact, we don't really pretend that we can forecast FX rates. And again, I think the evidence for forecasts in that area is very, very poor. But it is the case that there are different sort of dynamics prevail at different times. Back in the 1980s, when Paul Keating made his Banana Republic statements, it was all about the external deficit. Later, it was all about interest rate differentials. And more recently for Australia, it's been all about commodity prices. So interest rates are not going to be the only thing, but it is one of the factors that usually has an impact. Now, so if we did get that large gap, there would presumably be downward pressure on the Australian dollar. And if that was the case, clearly the overseas earners benefit. We call these translators, that is companies that have businesses offshore. QBE, Brambles, for example, come to mind. But they would be even more beneficial to companies that are exporters, because in that case, you get an increase in the margin. It's not just the translation, it's that your costs are in Australian dollars, your selling prices in foreign currency, the benefit there is much, much greater. Some of the exporters, whether that be our mining companies, energy stocks and whatever, or companies like Cochlear. Those companies who have costs in Australia but sell in US dollars clearly benefit the most, even more than translators. In contrast, for the domestic stocks, there's very little benefit. If there's a weaker economy, it does mean that there may be a bit more inflation in the system. Because of course, all the imported prices from petrol to cars to iPods, rise. I think a little bit of that would be welcomed by the Reserve Bank, and it may help, even some of the domestic sectors, retailers and the like. But of course, if it goes too far and rates have to go up due to these inflationary pressures, then then I think the domestic, particularly consumer discretionary and bank stocks would obviously be on the wrong end of that.